10 things you should know about bank stocks. With the backdrop of the regional banking crisis, if you're an investor, it's important as ever to truly understand bank stocks. We'll cover 10 key things every investor should know about understanding a bank. Number 10. Regulatory environment. Banks operate within a heavily regulated industry, subject to oversight by regulatory bodies such as the Federal Reserve in the United States. Understanding the regulatory environment is crucial when investing in bank stocks. Regulations play a vital role in maintaining the stability and integrity of the banking sector, safeguarding the interests of depositors and ensuring fair practices. Investors must be aware of the regulatory framework, including capital requirements, stress tests, and compliance obligations, as they significantly impact the performance and profitability of bank stocks. Evaluating a bank's adherence to regulations and its ability to navigate the regulatory landscape is essential for making informed investment decisions. Typically, these regulatory environments vary from country to country. Number 9. Financial performance metrics. When analyzing bank stocks, it's important to consider key financial performance metrics. Net interest margin, return on assets, efficiency ratio, return on equity, loan quality, and capital adequacy ratios provide valuable insights into a bank's profitability, asset quality, efficiency, and financial health. These metrics allow investors to assess a bank's ability to generate income from its lending activities, manage its expenses, maintain a healthy loan portfolio, and meet regulatory capital requirements. Examining these financial indicators helps investors gauge the overall financial strength and stability of the bank. Number 8. Interest rate sensitivity. Some bank stocks are highly sensitive to changes in interest rates. As interest rates rise or fall, it impacts a bank's net interest income, which is the difference between the interest earned from loans and investments and the interest paid on deposits and borrowings. Rising interest rates generally benefit banks by increasing their net interest margin, resulting in higher profitability. Conversely, declining interest rates can put pressure on a bank's net interest income and profitability. Understanding a bank's interest rate sensitivity is crucial for assessing potential risks and opportunities associated with changes in interest rates, enabling investors to make informed decisions. Number 7. Loan portfolios. The quality and composition of a bank's loan portfolio significantly impacts its financial performance and risk profile. Analyzing the types of loans held by a bank, such as residential mortgages, commercial loans, or consumer loans, provides insights into its exposure to different sectors and potential risks. Assessing metrics like loan delinquency rates, non-performing loan ratios, and loan loss provisions helps investors evaluate the credit quality and overall health of a bank's loan portfolio. A well-diversified and high-quality loan portfolio can indicate lower credit risk and enhance the bank's abilities to generate stable income. Number 6. Deposit base. The deposit base represents the funds held by a bank from consumer deposits, which serve as the primary source of funding for its lending activities. A stable and diverse deposit base is essential for a bank's liquidity and ability to meet its financial obligations. Analyzing a bank's deposit composition, including the types of deposit accounts, customer concentration, and funding stability, provides insights into its ability to attract and retain deposits. A strong deposit base helps ensure the availability of funds for lending, mitigates liquidity risks, and supports a bank's overall financial stability. Risks associated with a weak deposit base were key contributors in the failures of Silicon Valley and First Republic Bank recently. Number 5. Capitalization and stress tests. Banks are required to maintain adequate capital levels to absorb losses and ensure financial stability. Assessing a bank's capitalization ratios, such as its Common Equity Tier 1, known as the CET1 ratio, provides insights into its ability to absorb losses and withstand economic downturns. Additionally, regulatory stress tests evaluate banks' resilience under adverse economic scenarios, helping investors gauge their ability to navigate challenging conditions. Understanding a bank's capitalization and stress test results is crucial for assessing its financial strength and ability to weather economic uncertainties. It should be noted there are different types of stress tests for different banks. Not all banks have to undergo stress tests. Systemically important banks in the United States, otherwise known as too big to fail, undergo their own required stress testing post the mortgage-backed security global financial crisis in 2008 and 2009. Number 4. Economic cycle sensitivity. Bank stocks are highly sensitive to the economic cycle. During periods of economic expansion and favorable credit conditions, banks often experience increased lending activity, higher interest income, and improved profitability. Conversely, during economic downturns or recessionary periods, banks face greater risks of loan defaults, reduced lending demand, and lower profitability. Understanding the economic cycle and its impact on the banking sector is crucial for assessing the potential volatility and performance of bank stocks. Investors should consider the current stage of the economic cycle and its implication for credit risk, interest rates, and overall economic conditions when making investment decisions in bank stocks. A strong economy generally supports the performance of banks, while a weak or uncertain economic environment can pose challenges. Number 3, competitive landscape. The banking industry is highly competitive, with banks vying for a market share across various product lines and geographic regions. Evaluating a bank's competitive position, market share, and differentiated strategies is essential when considering bank stocks. Factors such as brand reputation, customer service, technology investments, and product offerings can impact a bank's abilities to attract and retain customers. Understanding a bank's competitive landscape helps investors assess its growth potential, ability to adapt to changing market dynamics, and long-term viability. Number 2, regulatory risks. Banks face regulatory risks associated with changes in banking regulations, compliance requirements, and potential legal or regulatory actions. Staying informed about regulatory developments and their potential impact on bank stocks is crucial. Changes in regulations can affect a bank's operations, profitability, and capital requirements. Regulatory compliance costs can also impact a bank's expenses and overall financial performance. Assessing a bank's ability to adapt to evolving regulatory requirements and manage regulatory risks is important for understanding the potential challenges and opportunities associated with investing in bank stocks. Before we get to number 1, here's an extra bonus thing you should know about bank stocks: dividend payments and share repurchases. Many banks distribute dividends to shareholders as a way to share profits. Evaluating a bank's dividend history, payout ratio, and dividend growth is important for income-oriented investors seeking regular cash flow. Additionally, banks may engage in share repurchase programs to return capital to shareholders. Understanding a bank's capital allocation policies, including dividend payments and share repurchases, provides insight into its commitment to returning value to shareholders. Evaluating a bank's capital management practices helps investors assess its financial discipline and capital allocation strategies. Number 1, earnings drivers. Bank stocks derive a significant portion of their earnings from core business activities such as interest income, fees and commissions, and investment gains. Understanding the key drivers of a bank's earnings is essential for evaluating its financial performance and growth potential. Factors such as loan growth, net interest margin, fee income diversification, cost management, and asset quality management play crucial roles in determining a bank's profitability. Analyzing these earnings drivers helps investors assess the sustainability and resilience of a bank's earnings, providing insights into its long-term value and investment prospects. Each of these factors play a critical role in evaluating bank stocks and making informed investment decisions. By considering the regulatory environment, financial performance metrics, interest rate sensitivity, loan portfolio construction, deposit base, capitalization and stress tests, exposure to the economic cycle, competitive landscape, regulatory risks, capital allocation, and earnings drivers, investors can gain a comprehensive understanding of the opportunities and risks associated with investing in bank stocks. When considering bank stocks, it's important to conduct thorough research, analyze financial statements, and monitor industry trends. Assessing the risks and opportunities specific to the banking sector can help investors make informed decisions aligned with their investment objectives and risk tolerance. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more financial education videos, share your thoughts in the comments below. Thanks for learning about bank stocks with me.